Hello and welcome. My name is Joe O'Mara. I'm the Head of Aviation Finance with KPMG. And on behalf of KPMG and Airline Economics, I'm delighted to be joined by Mike Inglese. Mike is the CEO of Aircastle. He's joining us for the purposes of our Aviation Leaders Report 2024. And I should say we're recording this in New York in mid-October. Mike, thanks so much for joining us again for the purposes of the report. Before we get into the meat of the conversation, do you want to tell our watchers a little bit about Aircastle?
Sure. Aircastle is a leading secondary market lessor. We've been in business 19 years in about a week. Currently, we own and manage 248 aircraft with about $7 billion of value. We're investment grade rated by all three major rating agencies, and we're owned by Marubeni Corporation and Mizuho Leasing of Japan.
Great, no, thanks, Mike. And maybe starting off with customer performance. We've seen a strong bounce back in travel. What has that meant for Aircastle over the last 12 months in dealing with your airline customers?
So I think the last 12 months, we've kind of worked our way through the last of restructurings. And for us in particular, I think the Azul restructuring, which they did with all their lessors, and then did some bond exchanges and put themselves in a good position from a cash perspective with a lot of runway going forward, was kind of the last of the COVID restructurings. And so that's done. By and large, performance from all of our other major customers has been much better this year. And I think we're starting to see now, perhaps with a few smaller airlines, maybe the seasonality of winter coming may be a little bit different for them than it was last year. And with oil prices going up and labor costs going up, I think some of the airlines might start to see the cost pressure squeeze a bit. But I'd say way better than 12 months ago, and feels like it's in a pretty good position.
Yeah, and maybe you can tell us a little bit of what that means on the demand side. So to the extent you have metal, we might come to supply in a moment, presumably demand is strong.
Yes, the demand is very strong, and we're, because of some of the supply chain and engine issues in the market, we're actually seeing NEO operators looking for CEOs to help them with lift as they're grappling with how they're going to deal with the groundings and their engine repair work. And particularly, and also on the NG side, there's a lot of people looking for lift, and those assets, the NG and the CEO, have seen pretty strong increases in lease rates as a result of the increased demand from airlines.
Yeah, and presumably that's feeding into, to the extent you have an aircraft coming off lease, extension primarily.
Yeah, I'd say the in any year or sort of cycle, between lease extension and lease transition, we've probably seen it, maybe 60-40 transition and extension, or 70-30. In this market, the number of customers who are looking to extend is a much higher percentage for us, and that's a good outcome for us. The transition costs are much less to extend an aircraft with an existing lessee. There's no downtime, and there's no surprises around engine borescopes and other things that can creep up. And in particular today, transitioning a lease is taking much longer too, because we're all subject to the same kind of supply chain constraints around MRO, staffing, and lead times around all the things that need to get done.
And maybe honing in on that supply side, Mike, and probably two aspects to pick your brains on. Maybe the first on the OEM side, right? So I know you predominantly play in secondary, but not exclusively. Can you talk to us about your perspectives on the OEM delays and the impact that's having maybe on the financing market?
So I think in the context of the financing market, I'm not sure there's a great direct correlation from our perspective. I think the demand for aircraft and the performance of the lessors has benefited from those supply constraints. So I think that's a good thing in the context of us raising money and showing the resilient performance of the leasing platforms to the debt investors and to the bank market. And clearly, the aviation bank market is strong. You've had a lot of new alternative lenders come in who are mostly interested in financing older assets and maybe more off-market kind of transactions for people that the traditional aviation banks just aren't that interested in doing.
Yeah, and then coming on to the engine side, is it a similar type of piece where you're kind of saying, okay, well, that's again constraining supply, and therefore by extension increasing demand. Your perspectives as a lessor on the engine challenges?
So the same thing. It creates demand for assets, both airframes and engines, and also just engines. We're able, in many cases, if we're going to part out and sell an airframe, we're able to sometimes keep the engines and put them on lease and use them within our own fleet amongst our customer base to defer shop visits and to deal with kind of the extended lead time that it takes to get any kind of maintenance done today.
Yeah, and you touched on lease rate factors in just one of your earlier comments. Can you speak to how they're evolving in this market?
Nothing goes up forever, and clearly we were coming out of COVID and coming from depressed levels, but the strengthening of the lease rates for CEOs and NGs is certainly in the double digits, and the NEOs and MAX lease rate performance, I think, has been a bit more muted of late, but it's a combination of the supply-demand issue, and it's also, I think, a factor of the dramatically rising interest rate environment we've seen in the last 18 months, and what's going to have to be sort of a normalization of lease rates in the context of what the financing costs are for the people involved in this industry.
Yeah, and when you think about those rising interest rates, again, with a lessor hat on, higher stable rates, are they good, bad, indifferent for your business?
I think higher stable rates will work its way back through the asset return requirements from all the participants. And so I think in time you'll see a normalization of that spread, but we certainly haven't gotten there yet, given how fast and how quickly and how high interest rates have moved from where they were from all-time lows for a decade.
Yeah, and maybe then bringing us on to the value side, is it, you talk to lease rate factors and maybe some of the older kit is raising higher than the newer kit. Is that similar from a values perspective? And maybe you could just talk to our watchers as well about just in this environment, what it means when you have a lease encumbered asset.
If you think about if you're buying a plane with a lease that was priced in the low interest rate environment, the so-called value of that lease will be less than what if you're setting a new lease today and maybe selling it in 4 or 5 years when interest rates are a bit lower. There'll be embedded value in that lease. So the flying bonds that are airplanes with leases attached, will get somewhat, hit when rates are up and you have a fixed rate lease that's going to run for another 5 years that was set in a different rate environment.
And then coming back to that values question, your perspectives on how those are moving in this market.
Same thing. I think they're moving in the right direction, and there's still a competitive bid around what we see and what we're doing in the secondary market. There may not be as many players, but there's still a pretty stable core of people like us who are looking to grow their business, and they're not necessarily funded and funding themselves in the unsecured market like we do, but they have backing of large private equity players and people who I think, the bigger ones of which I think will be in this business for a long time.
Yeah, and maybe on that trading environment piece, as you say, operating predominantly in the secondary market, you have a great lens and a long-term lens over how the trading environment has functioned. Can you talk to us how you think it's functioning now and how that's maybe evolved over the last year or so?
It feels like it's opening up more in the last 4 months or so, in the context of assets out in the market for sale, and in terms of, I think, people willing to think about what's the right way to price given what we see in the volatility of interest rates. And I think the rapid escalation during 2022 and the first part of 2023 made it a little challenging for folks to think about, how do I price that thing, and given how long it's going to take, and the conversation, which sort of really wasn't had for a long time in the industry around who's going to take interest rate risk, the buyer or the seller, suddenly reappeared, and people were very focused on, how do I protect myself, and can I put a collar on it? Can I find if it goes through this, I have the right to walk. And I think that was one of the that sort of readjusting to that whole interest rate environment and higher rates, created some additional friction around getting transactions done. But I think that's worked its way through, and I think people who are starting to be more active are using age-old tricks around how do you set that, how do you set it to a reference rate, and how do you contain that movement between agreeing and actually closing.
Yeah, and maybe on the liability side, as you mentioned, your investment grade gives you that ability to tap the unsecured market. I think you did that earlier this year. Was there anything different in going to that market in this higher environment? It's a higher yield, right? But was there anything else that was more challenging given the way the rates have gone?
I think because we all had been out of the market for an extended period, and particularly during 22, a number of us did some secured deals because rates moved really fast. It wasn't quite clear at what price you could get your unsecured deal done and whether you'd be comfortable with that. And as we moved into 23, it felt like it was stabilizing earlier this year. But I think we did in particular more sort of pre-deal marketing with investors because we really hadn't seen a lot of people and getting out again and having investor calls and making contact about what you've been doing through COVID, where you are now, and where you're taking the business. Required kind of a reacquaintance with everybody around what we were doing and where we were trying to take the business.
Yeah, so a bit more hand-holding.
But ultimately, and we were looking earlier this year, like in May, to go, and then the market got a little squishy, so we just said we don't need it now, we're going to step back. And then ultimately we got our equity commitment from our shareholders in late June, early July, and so we were ready, and we quickly went to the bond market with that news as a tailwind to make investors feel more comfortable about the capital structure and the path forward for Aircastle.
And maybe talking more widely on the aviation credit market, can I get your thoughts on how healthy that market is? It's clearly higher rates, but there's lots of different facets to it around, the traditional aviation banks, the unsecured market that yourselves and a few others can tap, capital markets products like ABS, and then the alternative lenders. As you look across the piece in the area of credit, your perspectives on the health of that market.
So look, I think there's plenty of credit available. It's a question about what price and in those different markets. And as I said, for us, when we were looking to raise some money in the second half of 22, we didn't like what we were seeing in the unsecured market and how spreads had widened. And so we explored the idea of a secured deal and got something done, probably 100 plus basis points inside of where we would have expected to have been in the unsecured market. And so having those long-term relations.
That was a private placement, wasn't it?
It was basically a bank deal.
Yeah.
So having those relationships with the aviation banks, with some of the alternative lenders, enabled us to get that done. Enabled us to extend and upsize some of our revolving credit facilities as we move through the first half of this year. But there's more money, particularly funded by the larger firms like KKR and Apollo and Carlyle, doing the alternative lending and making credit, their credit funds available to their folks who are both managing assets on the operating lease side, but also looking to do lending in the space where the traditional aviation banks don't care to play or have decided to shy away from some of the older assets or the less liquid assets.
Yeah, and if we look at the ABS space, which I don't think it's an area you guys have tapped in the recent past, but do you think it's a big miss for the sector at the moment, or are those other facets coming in and filling the gap? But it arguably was reasonably important pre-COVID, particularly in the trading environment, and the post-COVID deals were predominantly finance, maybe driven rather than equity sales. But your thoughts on the importance of that ABS piece to the overall aviation finance market?
Look, it's been an important piece in cycles over my 16 plus years in this business, and we did it right after we started in 2006 and 7, and even in 2008. When the ABS market itself sort of disappeared, we did an ABS-like transaction with basically bank investors rather than the folks who were buying ABS paper. And then, of course, we saw it ramp up and do significant volumes pre-COVID, had different structures, had equity participation, and was used more of a way to sell assets rather than as a simple corporate finance tool. And then, of course, COVID hit, and a lot of those deals struggled. Particularly lower tranches and E-notes suffered. So Willis announced they're going to do an ABS deal with engines. It'll be a single tranche. It'll be perhaps lower LTV than people were used to pre-COVID. But I think it will build some momentum, and I think ultimately it'll come back. Will it be next year? Maybe not that quickly, but I think it's reasonable to expect it'll come back in some form or fashion.
Yeah,
and the investors will help shape what it means in the context of what their performance and their experience has been.
Yeah, as you say, like a sentiment-driven market can flip back quicker than people think too, right? In that way. If we move on to the investor side, Mike, and you mentioned securing additional equity investment from your investor coming on the Japanese side. Do you want to talk us through maybe getting that commitment, right? And obviously they stepped in or closed the transaction at a challenging time, right? But have been there supporting you guys. Can you talk us through that relationship with the investor and getting their belief and support in the business?
Yeah, so I think they closed on our transaction just as COVID burst on the scene in March of 2020. So, of course, it was a giant shock to the industry, to the world, and of course to our two shareholders who showed up at that particular time. It was a very challenging year, lots of questions about what's happening and where's it going, and but with a view that they didn't do this, with a view that I'm going to be in this and be out in 3 years. They did it with a view of we like the long-term view of what we think is going to happen to travel demand, what that means for airplane production, and what that means for financing opportunities for leasing companies. And so, of course, at the time, nobody knew how travel was going to snap back, and there were all kinds of predictions of when and where. And by and large, it snapped back pretty quickly in the context of what happened. But we were all, in the industry, took our lumps. We, in aggregate, probably $500 or $600 million worth of impairments. Then Russia came along. And so we had to do some balance sheet repair. And the question was, how do we do that? And what's the most effective way to do that? And so we approached our shareholders and said, if we have access to additional equity, this is what we think we can do to this business over the next 5 to 10 years. And it took a lot of, re-education, and we still had very senior people within Marubeni and Mizuho Leasing who were familiar with the business, who knew us and our team, and believed in the story. But of course, you had lots of people in those organizations who didn't have a lot of aviation experience, and their first one was COVID. So it took a lot of education, a lot of work from the team in our office, from the team in Tokyo, who support our business. But ultimately, I think we convinced them that the right way forward was to invest additional capital in the business and let the management team go and execute on that plan.
Yeah, and at a more general level, looking at aircraft leasing, like Japan has been a long-standing investor into aviation, whether that's lessors like yourself or products like JOL and JOLCOs. When you look at the wider population of investors around aviation finance, do you think we've seen any interesting trends post-COVID, or is it a case of broadly the similar types of investors, albeit the names change some of the time?
Yeah, I think it's more the latter. Certainly some people have come, people have changed places, and some people, like at High Ridge, left GCAS with the AirCap merger, put their team back together in large form and got some capital to start a new leasing platform and start a new lending platform. So I think there's the sort of traditional sources who still believed in the business and still believe, the relative value in the world of all the things that they can invest in. And I think there's enough talent and people who were able to capitalize on starting fresh with no legacy, or pre-COVID and damaged by COVID portfolios, et cetera, to bring and keep bringing capital to the business.
And maybe looking at big picture leasing, post-COVID, we definitely saw a deepening and strengthening of relationships between lessors and airlines. And we saw lessors step up and probably fund more deliveries than ever before. So we breached the 50% proportion on a total basis, probably funding mid-50s, right, on the new delivery side, either on order books or sale and lease back. How do you see that evolving as we go forward in a situation particularly where some airlines are generating significant cash?
Yeah, so I think my view is we got a little of that kind of COVID tailwind to bump up the share of lessors, but I'm not sure that keeps growing. Whether it stays in the low 50s or drifts back to 50 or a little bit below, it seems like it's some reasonable range around where it is today. And as you said, many airlines have been starting to generate cash and have the ability to do different things. And whether they're going to change their philosophy around how much of my fleet do I want to finance in different markets and how much do I want to be leased to give me fleet flexibility, that will evolve over time. But I don't expect it to go to 60 and I don't expect it to go to 40.
Yeah. So we might be at an equilibrium now that's manageable and sustainable. And again, thinking on leasing big picture, you're an IG rated lessor, there's 8 or 9 of them maybe, right? And 1 or 2 who are going into that high yield market to get there too, right? Has scale increased in importance for leasing, so that particularly in a higher rate environment where I need to have the lowest weighted average cost of capital that I can have, or was it just always important and it's as important as it was before?
I think it's always been important in the context of trying to access the unsecured market and achieve an investment grade rating, because that was part of our struggle along our journey from high yield to investment grade, was particularly among some of the rating agencies, their view around what that scale meant in terms of dollars or number of assets that you owned and managed. But also now you've seen some big mergers and acquisitions, and so some of the big folks have gotten even bigger. And I think there's going to be, in my mind, a sort of a pull along that in order to keep up, in order to maintain kind of a relative strategic importance in that top 10 or 15 lessors in the world, it's going to be incumbent on people like us to continue to grow and remain relevant to as broad a set of airline customers as we can.
Yeah, no, that's understood. That would seem to imply that you might see more consolidation in the market. Do you think that's where we're heading?
I think you will. I don't know who and in what form, and maybe with the exception of Air Lease, who I would kind of never see participating in that given their approach to the business. I wouldn't be surprised to see some of the more meaningful people get together in time and try to leverage the human platform and try to leverage the scale and the kind of number of times and the amount of capital that they source from the market on a regular basis. I think as we've learned over time, when you're only going to the market once a year or once every 18 months for capital, you're probably not going to get the sort of tightest spreads because of the liquidity of your capital structure. And so having more opportunities to be in that market on a regular basis and also work with the banks and underwriters, et cetera, it kind of starts to feed on itself, that you become a more known entity, you're a part of an index, et cetera, and then some of those benefits of greater scale will accrue to you.
Yeah, and maybe shifting gears for a second, Mike, and focusing on ESG side, particularly the E. Can I ask, how much of your time, if any, right, does the environment play when you're interacting with either your equity investors or your debt investors?
So I'd say it's a topic of conversation. I'm not sure yet there's if you did this, you could pay less money for your money. Specifically, I think in time that may become more of a factor in what drives whether it's a sustainability linked bond or other types of financings, where whether it's an airline customer or a leasing company is putting some KPIs around whether it's the intensity of carbon of the fleet they own, or the percentage of new tech, or scope 3 emissions around their customer set. It seems like in time that's coming. I'm not sure at what pace, but it's certainly you have to be conscious of it. If it's your customers who are going to be hearing the drumbeat, I think, from their regulators and from their customers and their investors, and so it's going to be incumbent on the leasing companies to support the transition to new tech, which is, I think, the most meaningful way that we, as Aircastle, given our size and scale and business model, can do. We've grown our percentage of new tech from virtually 0 in 2018 up to about 33% today across our portfolio, and we'll continue, which is probably about where the market is by and large. And so we're not going to be the leader. We're kind of tailoring our portfolio to what's happening in the market at a rough pace of how that adoption is taking place.
And are you at the moment gathering that data? So would you have a perspective on, you don't use the assets, you say your scope 3, right? But would you have a gauge on what the carbon output is for your current fleet, or is that something that you guys are going to come at in time?
No, we just published our second ESG report in late summer this year, and so we are tracking the evolution of scope 1, 2, and 3 emissions for our business. And I think, as a practical matter for the industry more broadly, the increase in actual demand and flying year over year obviously shows a greater scope 3 footprint for everybody, which is, of course, good for economics. But I think the challenge with all of this is, what are you measuring, and how do you define progress?
Yeah, I think it's going to be obviously an evolving area we're going to come back to, and we're going to see a fair degree of regulatory shift over the next couple of years, probably European-led. And I think
and I had breakfast this morning with one of the big European aviation banks teams, and they've been working with some of their peer banks in the US and in Europe, and trying to define what they are thinking about in sort of managing their own institutions and their view on what they're financing and how their portfolio is, performing and improving around, greenhouse gas emissions.
Yeah.
And aviation can't, avoid being part of that conversation.
Just in closing, Mike, right, as you look at over the next 12 months, given the demand positives, the supply challenges, what are your optimism levels like?
So I'm cautiously optimistic that we're headed in the right direction here. There's clearly geopolitical issues that can flare up and be very disruptive and destructive. The interest rate and oil price and capital markets volatility makes it a little more challenging. But I think the underlying fundamentals of people want to fly, the supply chain constraints look like they're going to last for a while. And I think those are kind of positives for us as we think about deploying some of our new capital and finding opportunities to grow our business over the next 12 to 24 months.
Well, over that period, Mike, I wish you and Aircastle every success on behalf of KPMG and Airline Economics, and thank you again for giving us your time today.
Thank you. Pleasure to be here.